How to know when to cut your losses or take your profits. Hello, and welcome to our channel Pursuit of Wealth. This channel is your ultimate destination for learning about finance and wealth, investing and crypto, informational and educational trends in finance management. If you are someone who wishes to become wealthy and looking for smart money management options, then we are fortunate to have found each other. Are you an investor and worried about your continuous losses? Well, don't despair, because in today's video, we are going to discuss the best strategies for making profits and cutting your losses. Investing can bring you rewards as well as losses, but proper strategies can reduce the risks of facing huge losses. It's important that an investor should know about cutting losses and making profits. Without the fundamental basis of the economic market, investment for making a significant amount is impossible. Let's have a deeper look at the ideology of cutting losses and making profits. When to cut your losses. Cutting your losses simply means leaving or selling your stocks when its growth rate is declining, avoiding further losses. An investor will never invest in facing losses. You will never buy a stock if you have a gut feeling of its market value going down. A successful investor always takes out his investment at the right time to avoid losses. You cannot avoid losses because no one knows about the growth of your stock, but you can surely minimize them. Leaving the market before a capital loss is better than suffering from it. Following are the strategies you can adopt to avoid losses. 1. Stop holding stocks with huge losses. The investors who refuse to withdraw their investment even after experiencing losses are said to be fools in a true sense. Many people let their feelings win over their mental ability to think. Why do people invest depending on what their heart says? Investment is not about listening. It's all about ideas, planning, and strategies that come from the mind. Research has shown that about 80% of the investors refuse to withdraw their money after a loss. They expect their stock to grow soon, but the situation turns out to be the opposite. Their stock keeps falling. Resultantly, they face a huge loss. For instance, in December 2017, Sanderson Farms, SAFM, suffered a loss. The rate of stocks declined 17% in a week. If investors were intelligent enough, they must have sold out their stocks instantly. But rather than selling them out, they decided to act on the hold and hope strategy. Unfortunately, their worse attitude got in their way of bearing the minor loss. As a result, the stock kept falling to 42% in the next few weeks. If the investors had previously admitted their fault in selecting the wrong stock for investment and sold out of their stock at a 17% loss, they could have saved themselves from bearing a 42% loss. 2. Protect the money you already have. That's the prior rule of investment. Making profits or losses is far away from this. Your priority should be protecting the money you invested. How can you do this? The rule is simple. Set a margin of loss for yourself. We recommend you set the limit at 7%. If the stock you have invested in falls down at 7%, sell it immediately. If the stock is continuously falling and now the rate is 7%, then there is no possibility of it gaining back the growth potential. Declining the rate to 7% is a symbol of something wrong with the stock or market. If you refuse to sell the stock and stay on, hoping for it to grow back, then you will surely be at a greater risk of facing capital loss. The money you have invested isn't useless for you. You invested it to make a profit. Although it's no more capable of getting you profit, at least you can save your actual amount rather than losing it as a whole. 3. Never neglect your stocks. It has been commonly observed that investors initially take needed care of their stocks. With the word, taking care means keeping a constant track of the growth of the stock and managing their investment. However, their patience ends and their focus diverts as soon as time passes. Investors should know that no matter how steady your stocks are growing or how much their value is dropping, you must always keep track of them. Your neglecting behavior can cause you to suffer from capital losses. The investment platform is like a farm. If you keep sowing seeds and watering them, you will harvest the crop soon. But if you ignore the needs and requirements of your field, you will end in loss. So, always keep track of your stock to save your well-maintained stock portfolios from falling. 4. Sell if the stock is expensive. Now, let's talk about something that is an expensive stock. The most expensive stock right now is Tesla. The expense of Tesla is greater than the collective expense of Ford and GM. Although the growth of Tesla is not more than the other two mentioned companies, its extremely high rate predicts the success of its stock shortly. Now, coming back to the point, you have to check the price-to-earnings ratio, or P/E ratio, of the stock you're interested in buying or selling. The average P/E ratio floats 15 to 20, but it's not always the same. If the ratio increases by 30, it's your time to sell the stock instantly. The same rules go for buying. Never invest in a stock whose P/E value exceeds 30. It would help if you considered this rule for cutting losses. This is how you can cut your losses. Now, let's discuss how to take your profits. Taking your profits simply means keep your profit-yielding stocks to keep getting the benefit. Taking profit is the antonym of cutting losses. We have discussed how you can cut your losses, but what about taking profits? As an investor, you have to follow both of these investment parts to be a successful trader. Keeping the profit-yielding stock is as important as cutting the losses before they turn into huge losses. However, not every trader believes in keeping the profit-yielding stocks. Some traders sell the stocks as soon as they earn an estimated profit. By implementing the following points, you can know about the time of taking your profits. 1. Loss aversion. Loss aversion, as defined by behavioral economics, is one of the reasons why people ignore advice and cut losses early while holding on to losers for too long. This suggests that a possible loss is more destructive than a similar gain to one's mental health. Not every time, the possibility of loss in stock is being assured. Don't sell your stocks when the profit rate is at its peak to avoid loss aversion. 2. Disposition effect. In behavioral finance, the disposition effect refers to a sort of loss aversion in which traders hold on to losers for a long period and sell winnings too soon. This mental bias, in which losses loom larger than benefits, can be harmful. The better and more rational plan is to let gains run and cut losses, but this is psychologically more difficult to do in practice. If you are willing to sell a stock to make a profit, there must be the following 3 reasons for it. First, you didn't buy the right stock in the first place. Second, the P/E ratio of the stock has crossed the value of 30. Third, the stock has risen to an absurd and unsustainable level. It means that people tend to hang on to losers or even double down in the hopes of making a profit, often at the expense of taking on too much risk. Simultaneously, individuals will be concerned that minor profits would vanish and lock them in too fast. 3. The right time to sell the stock and take profit. A rule for selling a profit-yielding stock is to sell the stock immediately when it succeeds in providing you with a profit of 25%. We understand the decision to sell a stock is tough, especially when selling a profit-yielding stock. But the reason for this is that research has shown that stock starts to progress backward after reaching the profitable limit of 20 to 25%. Gaining a fair number of profits helps traders make large overall profits. You have to avoid being filthy for acting on this rule. If you get a 25% profit from stock and reinvest the gained amount to make a profit of 25%, you can make up to 100% profit that started from the amount of a single stock. For example, in April 2018, home decor retailer At Home Group's stock cleared a 34.02 buy point. It kept progressing for the next 1 week, but after gaining 20% profit, the progress stopped and fell downward. This is what most of the stocks do. The growth of the stock fell so much that it even passed the actual buy rate, causing investors to face a huge loss. Recommendations for safe investment. Following are the points to remember for being a successful trader. Make an investment strategy. Do proper research, set limitations for buying and selling stocks, and consider a quantitative analysis of market growth. The analysis can save you from huge losses and can fetch you greater profits. Think before selling a stock. The reason for buying a stock is obvious. You need to invest and gain profit to become a successful trader. But what about selling? It is going to be best if you had proper reasons for selling a stock. The valid reasons can be as simple as the elections are approaching and the stock will fall, so you decide to sell your account. Whatever the reason is, it needs to be authentic and clear. Keep analyzing your stocks. It would be best if you kept analyzing your losses and gains regularly. For example, if you feel that the stock you have invested in is currently at a loss and you regret buying it, you must sell it instantly. Don't invest all at once. Investing all at once can fetch you great profit, but think about losing all your money at once. Sounds terrifying. To avoid such a situation, prefer investing in parts to regulate a moderate amount of money. It is usually a smart practice to take remedial action before your losses deteriorate. Unfortunately, it is not always feasible to prevent losses in investing, but successful investors understand this and strive to reduce their losses. So, that's pretty much it for the video. Hope you get the idea of when to cut your losses and take profits. Please subscribe to the channel, like the video, and press the bell icon for more amazing content about wealth management and finance-related videos. Success is coming your way. Keep your doors open. See ya till the next time.